Hi everyone, welcome back to Corporate Decoder, the place where we decode the secrets hidden within corporate filings. And today's report from Hyperscale Data is a wild ride. Buckle up because we're about to dive into a financial roller coaster. Hyperscale Data Inc. just dropped its quarterly report and it's a lot to unpack. Think of it as a financial puzzle with some pieces missing and others that seem a bit out of place. We're talking about significant losses, new debt, and some very interesting business moves that make you wonder about the company's direction. Let's kick things off with the cash situation. As of June 30th this year, Hyperscale Data had about $5.9 million in readily available cash. Now, that might sound okay, but remember they also have $21.3 million in restricted cash, meaning it's not easily accessible for day-to-day operations. This means their quickly usable cash is actually quite limited. Looking at their liabilities, accounts payable and accrued expenses add up to a whopping $52.6 million. That's a big chunk of money owed to suppliers and for other immediate costs. And then we have the immediate debt obligations, the current notes payable, which are a staggering $87.7 million when you add up all their short-term debts, which includes convertible notes and other short-term borrowings. It paints a picture of a company very reliant on borrowed money to keep the lights on. Their total current liabilities stand at over $21 million. This is a huge amount compared to their total assets of around $13 million. This means a large portion of their assets are already promised to cover what they owe in the near future. Now for the big picture on their finances, their accumulated deficit is a staggering $687 million. This is the total of all their past losses since they started. It shows they have a long history of spending more than they earn. For the 3 months ending in June, they posted a net loss of over $21 million. That's a substantial dip in profit. And if you look at the 6-month period, the loss is over $27 million. This shows a continuing trend of losing money. Let's talk about their income. Their Centinum business, which deals with crypto assets mining, saw revenue drop significantly. For the 3 months ending in June, it was down to $4.7 million from $8.5 million in the same period last year. That's a drop of nearly half, mainly due to the Bitcoin halving and increased mining difficulty, even though the Bitcoin price went up. In contrast, their energy segment, which is their crane operations, saw a slight dip of about 1%, bringing in $11.6 million for the 3 months. It seems like this part of the business is holding steady, but not really growing. The fintech segment involving lending and trading had a dramatic swing. It went from a negative revenue of nearly $9.8 million last year to a positive $1.8 million this year. However, this positive performance was largely due to selling off investments and some fee income, not necessarily a sign of a booming core business. This mixed bag of results is reflected in their gross profit. Overall, it did improve significantly compared to last year, mainly because of those fintech gains. But if you look past those specific activities, the underlying business, especially crypto mining, is still struggling with profitability. One area where they increase spending quite a bit is in selling and marketing, with expenses jumping by 69% for the 3-month period. This was mainly driven by increased advertising costs at their ROI segment, which focuses on AI software and gaming. On the flip side, their general and administrative costs went down by about 13%. This seems to be a positive move, likely due to streamlining operations after deconsolidating some subsidiaries. There was also a significant event last year where they recorded an $8 million impairment charge related to their hotel properties. This means they had to admit that those assets were worth a lot less than they previously thought. This year, thankfully, they didn't have a similar large impairment. Now let's talk about debt. Interest expenses are up. For the 3 months ending in June, it was over $7.6 million, a big jump from $5.3 million last year. A lot of this increase is due to new convertible notes they've issued, which come with higher costs and complex embedded features. They've also had a number of losses when they've restructured or paid off old debts, referred to as extinguishment of debt. For the 6-month period, these losses added up to $4.6 million, including significant losses from issuing new notes that were substantially different from the old ones. Looking at how cash is moving, their operations are still using up cash. For the first 6 months of the year, they used over $7 million in operating activities. While this is an improvement from last year, it still means the core business isn't generating enough cash to cover its own expenses. The big picture shows they are still burning through cash, and this is a recurring theme for Hyperscale data. They mention raising capital through selling equity or debt, and also selling crypto assets as their main strategy to stay afloat. Their debt structure is quite complex. They have various convertible notes, some with high interest rates and original issue discounts, meaning the stated interest isn't the full cost. Some are even in default. The total principal on these notes is over $21 million, and that's before you consider the added costs and potential conversion impacts. A major event for them this year was the sale of their Series B convertible preferred stock. They raised nearly $7.9 million from this during the second quarter. This preferred stock is quite complex, with high dividend rates and conversion options that can significantly impact the company's equity structure. Now for some legal drama. Hyperscale Data is facing a breach of contract lawsuit from Arena investors. The lawsuit claims damages of over $3.75 million. While they've had some success in getting the case dismissed against one of their subsidiaries, the main claim against the company is still ongoing. This kind of litigation is a significant risk, as an unfavorable outcome could really hurt their financial health. The financial tables also reveal how these losses are impacting the shareholders. After accounting for preferred dividends and other corporate activities, the net loss available to common stockholders is substantial, showing a significant hit to the value for ordinary shareholders. Looking at the total revenue, it has increased year over year. For the 6-month period, it was about $50.9 million this year, up from $56.2 million last year. Wait, that's actually down. Let me recheck. Yes, total revenue decreased by almost 9%. This is mainly due to the drop in crypto mining revenues. When we look at the company's assets divided by segment, the Agree segment, which is their hotel and real estate operations, holds a significant portion of the company's assets. This shows their diversification strategy, but also raises questions about how these different, somewhat unrelated businesses are managed together. Turning to their accounting policies, they are continually evaluating new financial reporting standards. While this is standard practice, it highlights the complexity of their financial operations and the need for robust accounting procedures, which they themselves admit are currently lacking. Speaking of controls, Hyperscale Data explicitly states that their internal controls over financial reporting are not effective. They've identified several major weaknesses. This includes not having enough staff in their accounting department to properly handle financial reporting, particularly with complex areas like consolidation and fair value estimates. They also struggle with proper segregation of duties and IT system controls, especially concerning revenue recognition and crypto assets. This is a significant red flag indicating potential risks of errors or even fraud. So what does all this mean for Hyperscale Data? On one hand, they are diversifying and trying to grow through acquisitions and new ventures. The increase in revenue from some segments like Agree and Turn On Green is positive. However, the core crypto mining business is struggling, and their overall financial situation remains precarious. The massive accumulated deficit, the reliance on frequent financing rounds, and particularly the acknowledged weaknesses in internal controls, all point to a company facing considerable challenges. The ongoing lawsuit from Arena investors adds another layer of uncertainty. They are essentially walking a tightrope, hoping that new capital and operational improvements will steer them to stability. It's a high risk, potentially high reward situation, and right now the risks seem to be front and center. Alright, that's our breakdown of Hyperscale Data's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.